Hey traders, in this video we're going to look at the dead cat bounce strategy for swing traders. Hey guys, a very warm welcome to you. So I think we've discussed dead cat bounce before, but on an intraday basis. I like intraday trading. Dead cat bounce is one of the good strategies you can employ, especially when you've got a gap down intraday on a catalyst from a stock. You can trade this kind of thing. However, it's also pretty useful for stocks on a swing trading perspective, shorting stocks that are really under the cosh and are continuing to be beaten. So let's have a look at how it all works. So generally dead cat bounce is brutal name for it. Dead cat bounce is that dead cats may bounce but they're still dead. I guess that's what it is. You know what people are like, guys. Candlestick patterns have got the most stupid names ever. They don't know where this come from, but hey, it is what it is. The point of the thing is how do we make some money out of it? The idea is that a stock or a market, and a stock specifically, because generally speaking, a stock, if it's a broken stock and it's bad news, it's gonna get hit. In other words, people are gonna be pulling money out of it, which involves selling. There's no fresh buyers coming in, there's very few fresh buyers coming in. Vultures are gonna be pressing shorts on it, so you get a lot of demand coming, a lot of supply coming in and not much demand. And so this is the opportunity that presents itself for us as swing traders to get onto this dead cat bounce strategy. So imagine we have, normally we might have a catalyst here, let's say an earnings or something like this, whatever it may be. But the point is now we are in a really strong, brutal downtrend. And the dilemma is if you're a short, you want to be short, where do you kind of short this thing? And this is a good opportunity to jump on this at a good place. You don't want to kind of dive in here. I know in hindsight it will look good, but you don't want to chase stuff because you know that short rallies are pretty kind of brutal. If you ever trade in a bear market, they're pretty savage, especially on the wrong end of them, believe me. But earnings comes in, something comes in, hammers the stock low. What do? The market then starts to push up, and this is the part, this bit here is the dead cat bounce, right? That's the dead cat bounce. And if we kind of zoom into it over here, let's have a look. So we've come down here, oh, now we're starting to push back up, and imagine that bit is there. So what are we looking for? First of all, we don't want this to be too high in proportion to the big move down. We want it to be, maybe 20% max. But the point is it's come off the low. All the bulls are saying, whoa, look at that. It's like a 20% move off the low, or 10%, 30%, even 50% move off the low. But we put it into perspective. If we're true traders, we'll say, well, yeah, all right, it was $100. Yeah, it's come down to kind of, I don't know, $30. And these guys are getting excited because it's come up to 60. I know my scale's not quite right there, but you get the point. They're saying, whoa, they're getting all excited. But we're putting it in the bigger context. Now, this is the dead cat bounce. The idea is this is just a bounce. This is a lot of people diving in too early. It's a lot of shorts taking quick profits who had kind of been a short before this. And they're like, yes, you know what? I've made from 100 to 30, good trade, done out. And the supply demand shifts very quickly on this dead cat bounce because a lot of people dumping stock don't dump stock because they want to dump stock. They dump stock because they don't want to hold something that's losing. So when they back off and everyone backs off at once and we get some buyers in and they see this thing double, they're like, oh, okay, well, maybe I don't need to dump stock anymore. And so the selling shuts off. Shorts get a little bit burnt who are chasing, that shuts off, turns to buying to cover. Buyers see this rise, it comes up on the biggest gainers, screeners, wow, they all pile in. So we get a massive shift in supply demand back into demand from supply. That's where we get this aggressive bounce. However, once that has run its course, the idea is that this will then roll back over and we'll go to fresh lows and we'll be back down at kind of $10 or whatever it may be. I'm just making those numbers up, but you get the idea. So what are we looking for at that sweet spot that's going to give us the idea to trade a dead cat bounce? Well, first of all, don't be a hero. Don't try and short it into the bounce. Let the bounce happen. We're looking for a secondary or third reaction to a specific point to get involved. Let me explain what I mean by that. So we come up, we don't get involved in the front side of the move. Okay, we don't get involved. This could, if it's a V-shaped reversal, maybe there's been some news here and this thing's going to fly back up to 100. We don't want to be short. We want to be short. It's a dead cat bounce. So while it's still doing that and it's not encroaching too far up and it's just kind of plodding up, and we still think it's dead cat bounce, but we don't want to pull the trigger yet. We want to wait and see what's going to happen. So a great thing to do is to look for something like a double top that fails. Some kind of reversal pattern, bearish pattern at the top of a dead cat bounce. Maybe we have a bearish engulfing candlestick. I've done a video on this before, but that kind of structure where we've got, you know, green, 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 and then all of a sudden big red that just engulfs all of that trade, or even engulfs 2 days of trade. Some sort of bearish signal that goes, yep, right now I'm going to pull the trigger on the short, bang, short stop's going to be here. You need to find something like this, whether it is that double top, whether it is the bearish engulfing, so that you can quantify your risk as a short seller. You don't want to be piling in this thing and having it go against you and thinking, well, it's still a dead cat bounce. It may be, but if your timing's wrong, the thing could double again on you, and you can't trade like that. That's not a good way of trading. So you need to find some way or some trigger, some signal for you to hit that with a short on the short side. And that could be, like I say, creating some kind of resistance, maybe double top, maybe a triple top, maybe a candlestick pattern at the top or perceived top of that dead cat bounce. And then you can hit it on the short side, then you can quantify your risk. If it breaks through, you take a loss. You have another crack later on. The important thing is when you start to see the supply demand shift, you can have a go at it on the short side as long as you have your risk quantified. You're not doing it on the way up and getting hammered, and that's the mistake that many traders make. They're kind of selling into this saying, yes, dead cat bounce, dead cat bounce. Well, yes, but if you're selling it, it's come to 30 and it's bouncing, and you're shorting at 40, it's gone up to 60, you've lost a heck of a lot of money. It's not feasible, it's not a good strategy. So you let it bounce, then you wait for the second and third signals to say, hey, this could be turning now. So that's one. That could be your kind of secondary signal, like a bearish engulfing double top. Or you kind of wait until you start to break through supports that have occurred on the way up. You know, because on the way up, if you're talking about a swing trade, you know, it might be doing this, guys. It might be kind of finding some support and then going up. That might be the dead cat bounce pattern. In which case, you've got these lines drawn already, these key levels, and you're saying, okay, well, actually, I'll trade it on the back side of the move as it starts to roll down, break through those support levels and hold below, then I'll take the short. Sure, I'm not early, but at least I'm waiting until I see the weakness coming in, the whole bigger reason why this thing is getting hammered in the first place, to put pressure back on the stock as opposed to just the technical bounce. Then I can start to press my shorts, and if you're ultra aggressive, you can start to pyramid in and really squeeze that thing for a move to lows, and that move to lows generally will be quite exaggerated because a lot of people are buying that dead cat bounce because they think it's a recovery, think it's a bargain because it's at 30 bucks and it was $100. In actual fact, the stock's dead, they're losing, they're selling, and you've got the big wave of sellers who were involved in the initial selling, dumping stock. Double whammy on it. You're short on something that everyone wants to get out of. That's no better trade to be in. All right, guys, see you next one. Take care. Bye-bye.